Hi, I'm Allan Madan from Madan CPA. In this second part of our guide to becoming a non-resident of Canada, we'll walk you through the essential steps to establish non-residency, navigate life as a non-resident, and tackle challenges like the snowbird dilemma. If you haven't already watched it, check out part 1 of this 2-part series. That video is in the description box below. Now let's get into the 7-step process. Step 1. Check for a tax treaty. First, determine if Canada has a tax treaty with your destination country. This is an important first step because it impacts the following steps you need to take. Tax treaties prevent double taxation by ensuring you are not taxed on the same income by both Canada and the other country. Visit CRA's website to see a full list of Canada's current tax treaties. In treaty countries, your residency for tax purposes depends on the tiebreaker test. The tiebreaker test is a hierarchy and goes like this. Number 1, where is your permanent home? Number 2, where are your personal and economic ties the strongest? Number 3, where do you spend the most days? If there's a tie on the first test, you go to the second test, and so on. For example, let's say Shirley owns an apartment in both New York and Toronto, her permanent homes, works in New York, but has a spouse in Toronto and personal belongings in both places. She spent 210 days in New York during the year. Based on the tiebreaker rules, she would be considered a deemed resident of the United States and a non-resident of Canada. Step 2, set your departure date. Your departure date is key. It's the day you officially stop being a Canadian tax resident and impacts how much taxes you will pay upon departure. Make sure you've planned your move, resolved personal matters, and coordinated with family. You generally become a non-resident of Canada on the latest of the following dates. The date you leave Canada. The date your spouse or common law partner and dependents leave Canada. The date you no longer maintain a home or residence in Canada, whether leased or owned. And the date you become a lawful resident of your new country. For example, when you obtain a work permit, dependent visa, or permanent residency card. For countries without a tax treaty with Canada, you must sever primary ties with Canada, which can be done by selling or renting out your home and relocating your spouse and dependents to the country you are emigrating to. For secondary ties, cancel memberships, sell vehicles, and close Canadian bank accounts. If there is a tax treaty, refer to the tiebreaker rules to ensure you are considered a non-resident of Canada. Be careful about where your assets are, but typically you can maintain a few secondary ties and even primary ties in some cases. If you choose not to sell your primary residence and decide to rent it out, you will need to get a property appraisal and file the necessary forms, such as Form T2091 for principal residence exemptions and T1159 for rental income. Step 4, secure lawful residency abroad. The next step is to obtain lawful residency in your new country. Whether it's through work, family, or special programs, your residency status abroad solidifies your non-residency in Canada. Step 5, close financial ties. Now, you'll need to address your financial ties to Canada. Start by notifying banks of your status change with Form NR301 to reduce withholding taxes. We also recommend you stop contributing to accounts like the TFSA and RRSP once you leave Canada. You can still hold onto these accounts after becoming a non-resident, but there are penalties for contributing to your TFSA, specifically after your departure. Step 6, appraise and disclose assets. Appraising your assets at their fair market value will be how your taxable gain or loss is calculated. Assets include real estate, marketable securities, or any assets held personally or through your business. Get these appraisals done professionally and fill out Form T1161 to disclose these values when filing your departure tax return. Note that Canadian real estate held by an individual is not subject to departure tax, but it is still reported on Form T1161. Step 7, calculate and file departure tax return. The final step is to calculate and file your departure tax return. Departure tax is most commonly applicable to assets such as shares in private corporations, marketable securities held in non-registered accounts, foreign real estate, and Canadian real estate held through Canadian corporations. Departure tax is essentially a capital gains tax based on the fair market value of your assets at the time you cease to be a resident. If you have significant appreciation in your assets, you may face a large tax bill. For example, let's say you invested $50,000 in Apple stock in 2009, and by 2024, the year you emigrated from Canada, the stock has appreciated to $200,000. If you decide to keep the stock after leaving Canada, you'll pay departure tax on the $150,000 capital gain, the difference between the current fair market value and the original cost. There are 4 ways to minimize your departure tax burden. Number 1, if you own a private corporation, pay a final dividend to yourself before leaving. This is essentially a liquidation of the company's assets, which reduces the value of the company. Number 2, if you hold assets in non-registered accounts, close or liquidate them. Number 3, get an appraiser to determine the lowest possible market value on any foreign property you own. Number 4, if you own real estate through a corporation, purchase the property personally to realize the capital gain. Once you determine your departure tax, you can either pay it when you leave or defer it using Form T1244. After you complete those 7 steps and depart Canada, you'll be considered a non-resident. While in most cases you can completely move on from Canada, there are some cases where you'll have ongoing tax obligations. These include individuals who receive payments from a registered pension plan, RPP, money from the Canadian Pension Plan, and old age security, or rental income from Canadian properties. For most types of income, you may be able to reduce the withholding tax rate at source by applying the relevant tax treaty. For example, pensioners may be able to reduce withholding tax on their pension income from 25% to approximately 15% if a tax treaty applies. To do this, you will need to file Form NR5 before leaving Canada. The final thing to consider is maintaining non-resident status. This is simply about the number of days you spend in Canada, which should be less than 183 days during the tax year, as well as your primary and secondary ties, buying a home, the location of your family, personal property, and so on. Becoming a non-resident of Canada requires careful planning to ensure compliance with the Canada Revenue Agency rules, whether it's departure tax, withholding tax, or snowbird obligations. Consulting a professional ensures a smooth transition to your new life. That concludes our 2-part series on the tax implications of leaving Canada permanently. Thank you for watching this video. And if you have any questions about becoming a non-resident, don't hesitate to reach out. My contact information is in the description box below. See you in the next video.